Let's first talk about the broader tech sector. Now, when we look at tech, it's been hit by this Omicron variant. Earlier this year was kind of hit by rising 10-year yields. Where are you at on tech? What do you think is working in tech? What do you see not working in tech?
Yeah, it's been an interesting back half of the year, to say the least. And I think the one thing that jumps out, to most investors who are especially close to the space is just kind of the choppiness within the group. I mean, it's either been names like Alphabet and Microsoft and Apple providing that massive leadership in terms of large caps. Semis have been on fire. And then when you get under the hood, it's like the Grim Reaper has been knocking on door one by one slowly. It started with the SPACs. It's come around to unprofitable tech. It's made its way to the payment space. And as of look at the tape yesterday, the SaaS complex and the cloud names are really the last shoe to drop. And, hence you had a long list of names, trading down well over 10%, and those stocks are trading north of 25 times sales.
You mentioned the SaaS names, but I want to actually pivot to the payment stocks and the fintech. When the pandemic first started, we were all going to get rid of our cash. We were only going to use our cards and our fintech apps. What's going on? Why are these payment apps being hurt? Because I always thought that e-commerce and this digital spending was supposed to be sticky. Why aren't investors seeing the narrative that these companies are only going to see their revenues grow and their engagement grow?
Yeah, I mean, unfortunately, if you look at names like, say, Visa, MasterCard, Fidelity Services, which is FIS, and GPN, these are more the legacy names in the payment fintech space. And, one issue they've been dogged by, fundamentals have been very underwhelming. They all kind of reported very lackluster, quarters and then issued, downside guidances when they last reported. But they're really being negatively impacted by this extremely choppy recovery. And obviously, it depends where you're located geographically. But and as we know now, with Omicron, rearing its head, another kind of roadblock and a hiccup for the group, and in terms of things just kind of returning to normal, that can's being pushed out. So choppy recovery, still somewhat of a lack of corporate travel returning to anything what it was a couple of years ago, and I think from in a world where factor rotation is much more pronounced, they're not growth, they're not value, so they sort of have no identity. And investors have just shown no appetite for those type of stocks in this tape, and hence why they're all kind of just crashing towards really 52-week lows yesterday, obviously.
Yeah, difficult time for that space. So really quick, we're saying that payments and fintech aren't working. The SaaS space, that service, what is that? Software as a service sector being hit as well. What's working? What's best in class when we talk about mega cap tech? Where would you put your money?
Yeah, I mean, unfortunately, not unfortunately, but it's like the simple names have been outperforming. And Alphabet's still my number one pick. It's up nearly, I think, 68, 69% year to date. And I think for three reasons. They're obviously, benefiting greatly from recovery in the search business, and that continues to fuel kind of revenues and margins higher there. YouTube remains kind of the crown jewel of the entire business as well. And then the renewed focus on cloud. So they're still a distant three behind Azure and AWS, but they're gonna. I wouldn't be surprised to see them make a big splash in M&A and cloud and kind of try to close that gap a little bit. So Alphabet's still my horse. Microsoft's number two, and then I think you have to also. You guys have touched on it. Apple's down 2% in the pre on some negative iPhone demand chatter. So that's one to watch this morning, because that's obviously done a lot of heavy lifting over the past week or so.
Got it. All right. Something everybody's watching is Cathie Wood. You and I spoke on the phone yesterday. I'm going to put you on the spot. You brought the heat about this. The ARKK ETF, about 40% behind the NASDAQ this year. What's your take on that ETF and Cathie Wood's investment strategy?
I mean, that's kind of the great mystery, to be honest with you, and that comes up in a lot of conversations. Just obviously, she's leveraged to unprofitable tech. We all know we're in a raising rate environment. She was levered to the COVID winners, whether it's a Teladoc or Zoom. I mean, I don't know that many people who thought coming to 2021, as we return to normalization and reopen, that these stocks were going to continue to work to the degree that they did in 2020. And there's just really, the thought process is a little bit of a mystery. Adding to the Twitter, she continues to average down in charts, which is just telling us that there's something else going on in these stories. And I think the charts are very telling. Where she has nailed it has been Tesla. And I know you just shared the soundbite from her. So you got to give her credit on Tesla. She's and that's obviously a 10% weighting in her flagship ETF. But man, if you strip that out, I mean, the performance would be probably down 50% versus the benchmark, which is pretty astounding when you're running a long book.